Hello and welcome to a new episode of the Data Door Front Porch podcast. We have a packed show today after a very surprising, or in some ways unsurprising, but in other ways very surprising earnings. Last week, Opendoor um, reported Q4 2022 earnings, and the result was in some ways um, different than what we expected. Tyler, walk us through it.
Yeah. So Thursday, Opendoor reported after the close. I think, for us throughout 2022, when we estimated for the quarter, we felt pretty good across the board for all the KPIs that we measure. Um, and we released our own internal estimates on Wednesday before the earnings. I think we came in pretty much exactly in line for things like homes sold and revenue, as well as homes purchased. Where we were a little bit different was actually gross margins, which I think surprised us. Uh, Opendoor actually posted adjusted gross margins of negative 3.2%. We were expecting somewhere closer to negative 1%. And in fact, negative 1.6% was the lowest end of our range. And so I think that has prompted a lot of research on our part over this past weekend to investigate the reasons why there might be such a discrepancy between observed and or estimated and actual. And I think we have some ideas.
For context, like Q4 in terms of housing market was a really difficult quarter. If you look at the sales numbers that are coming out now, for like Q4 and even for January, the home data sales numbers, it was really depressing volume. So Opendoor was likely to likely trying to move homes, and with that, might have giving more concessions than we can observe in the data.
Yeah, I think there's three possible explanations for the discrepancy in the data. One is that our data are wrong. Um, and I think to to sort of look into that, we have north of 130,000 transactions for Opendoor in the database. We have sales estimates going back 20 plus quarters. And I think what we've seen from the data is actually that we're always within 5%, less than 100 basis points at most of gross margin in all of those quarters. So our methodology we feel pretty strong about, and I think that that's reflected in the fact that we nailed um, homes sold, revenue, homes purchased, et cetera. And we did that in all the other quarters we've done this as a business. And so that's option one. Option two is that there was an outsized effect, uh, uh, margin drag from non-disclosure states. And so there are states where sales data are not publicly available. And so states like Texas, Utah, for example, are states where uh, the sold price of a home is not public information. And so therefore, we have no visibility into the sales margins or sales price of homes sold in those markets. And in Q4, for example, 1/4 of all Opendoor transactions were in these non-disclosure states or markets. And so that means that we only had visibility into 75% of Opendoor sales transactions. But if you kind of walk that back and think about how bad those markets would have to perform to create the delta between our estimated negative 1.1 margins and Opendoor's actual negative 3.2 margins, markets like Texas would have had to be the worst markets in Opendoor's entire category, right? They would have to be almost as bad as San Francisco, worse than Phoenix, worse than Las Vegas. Um, and if you look at the metrics in those markets, it just doesn't make much sense, right? Like the price cuts in markets like Dallas, Fort Worth, Houston, Opendoor's largest two markets in Texas, are actually really low, right? Like they have all of the metrics of top markets for Opendoor, and that's sort of the proxy that we've been using for Texas markets, is things like price cut, percent pending, et cetera.
As additional context, just in case people are confused why we have data on price cuts but not on the actual margins, uh, listings data is actually available. So if a home sells on the open market, we can kind of guess based on the last listed price or sales price in the MLS what the actual sales price was. But the purchase prices are not. So Opendoor doesn't purchase on the open market. They buy this privately from sellers. That is not reported in the deed data. So there's no listings data on their purchase price. We see their listing prices. We see how many price cuts they're making until the home sells. And that's what you're saying is way better than a market like Phoenix. So it's unlikely that the margin is anywhere close as negative as Phoenix or San Francisco.
Right. Like Phoenix and San Francisco have mean price cuts maybe in the 5+% range per home, whereas Dallas Fort Worth, for example, Opendoor's largest market in Texas, is closer to 2%, right? Which is even better than a market like Atlanta, which is perennially one of Opendoor's stronger markets. Basically, what I'm saying is the Texas markets outside of Austin's pretty bad, but Dallas Fort Worth, Houston, and San Antonio, 80% of Opendoor's Texas business all have the metrics of markets with positive unit economics. And so that brings us to option number 3 to explain this delta or this discrepancy. And that's that Opendoor is granting seller or buyer credits to increase the velocity of transactions. And there's precedence for this, right? That happened, for example, at the end of September, so the end of Q3, so that Opendoor would be able to close on more sales, to offload more of this Q2 inventory. And there's actually an economic benefit for it, right? Every day that Opendoor owns these Q2 homes that are never going to make a profit, Opendoor is paying property tax, HOA, right? Maintenance fees, selling fees, marketing, all the above. And so offloading this inventory as quickly as possible is a benefit to Opendoor. And so it makes sense to incentivize these sales. The problem with this as an explanation is it's completely invisible to data methodology, right? It's invisible to scraping. And so it creates a lot of variability in collecting data. And I think that we saw that for Q4, the gross margin results were 200 basis points worse than expected. And we certainly saw it for Q1, where Opendoor guided for even worse gross margins than Q4. And we're seeing an improvement in margins in Q1. I think that definitely bears discussion as well.
Yeah, and what you mentioned, what's different from Q3 is that they announced what kind of commission bonuses they give to agents. So we could incorporate that into our uh, estimates. This time, we didn't even know this was going on. There was some reports on Reddit, but you never know how widespread it is. If they only giving seller credits on a few homes, they always give seller credits on a few homes, or what the scale was. And what the data shows is the scale of seller credits and rate buy downs was probably quite big. Yeah,
Very,
but that
very.
brings us to the last point that you mentioned. Is like the Q1 guidance is not at all what we are seeing the data for Q1 so far. Q1 has been quite an impressive quarter so far, right?
Yeah. So we've seen pretty much week on week, with the exception of maybe 2 weeks, an improvement in Opendoor's gross margin since mid-November, right? Like every week, it's increased. The trend is going like this. So mid-November, middle of Q4, right? And now we're at the end of February, so 2/3 of the way through Q1. We were expecting Opendoor to guide for positive gross margins in Q1. And then they turned around and guided for -5% gross margins, which is worse than their guidance for Q4. For Q4, they guided -4.4%. They posted -3.2. Now for Q1, they're guiding for -5%. It just, the discrepancy doesn't make sense. And I think that this is another reason why we're gravitating towards this explanation that Opendoor is offering these seller credits to ensure that these transactions happen. I think another piece of data to support that point is that in Q4, 90% of Opendoor sales were the Q2 offer cohort. In Q1, 60% of Opendoor sales are from the Q2 offer cohort. But it's important to understand that for any given cohort of homes, the first homes that you sell are the best homes in the cohort, right? Like we've talked about this in the past, the lemon problem. The farther along you get into that cohort, the deeper you get, the worse those homes become. And so ostensibly, you're in a situation where in Q1 and Q2, selling off these remnant Q2 offer cohort homes is going to require more incentives, more work, right? And it potentially lower margins. Ideally, we'd see this in the actual bought and sold margin data, but it seems like Opendoor is doing this sort of just with the seller. And so the only people that know the actual value are Opendoor themselves and the individual transactor.
I think what's important to mention is this is not necessarily worse than what they had in write-downs in Q3, right? They made it in terms of gap numbers. They made a huge write-down in Q3 saying, hey, all the homes we have on our books from the Q2 offer courts, they will be massively uh, negative gross margins. What we expected is that this was a very conservative outlook, and they, because it was such a massive write-off, that we will see kind of that balancing out more, especially the gap numbers, which was also worse than expected in Q1. And now there's a lot of hope out there that so how write-downs work, I guess we have to explain it. Write-downs only account for negative margins. So they are forecasting or trying to anticipate what price all those homes they have on the books will sell. And they take all the negative gross margins of those homes and take them as a write-down. It excludes all the homes they might make money on. So those would balance it out and maybe push them into a more positive gap accounting, because write-downs are only, you only adjust inventory values negatively. You never increase the value. So now looking into Q1, which will report in May, they will have a large or majority of their homes sold, right? And at that point, we can see was it worse than they expected in Q3, or was it as bad as they expected?
Right. And I think it's also important to emphasize too is it's February the 26th right now, right? And so there's 1 month left in Q1. But for real estate data, we have access, like through Datador, we have access to pending data. And so for us, the quarter is already over, right? We already know all of the transactions that are going to happen in the quarter. We know the gross margins, we know the revenue, we know, you know what I mean? We have all of the data basically except for the number of homes purchased. And so for us, knowing all these data and seeing Opendoor's guidance for the quarter, it's really hard to reconcile the differences because they are huge. It's an enormous difference between what we're seeing in the data and what Opendoor guided for. And I think that that's been one of the more shocking parts of receiving the data and also doing the research this weekend that kind of led to this podcast.
And it's not even just on the bottom line. Even the top line is quite surprising, right?
Very different.
So, yeah, we will, I guess, see in the next few weeks as those pendings close, as well as when Q1 is announced, how different it is. If this is like some form of sandbagging to come out in Q1 with maybe a more surprising outcome, it would be a strange strategy. You don't want to be sandbagging at the point where they are right now, but maybe that's part of it.
I hope that's not a strategy because
Yeah.
uh, yeah, I would not recommend that one. But knowing Carrie, or at least knowing kind of about her style and everything, she seems kind of like a no nonsense type person. Obviously, she's
Yeah.
been responsible probably for the majority of the estimates so far throughout her tenure as Opendoor's CFO and now CEO. And they've always sandbagged a bit, but this would be more than we're okay with, right? This isn't like a beat and raise kind of situation. This is like a huge departure from what the data say.
Yep. Um, Talking about some of the other things that Carrie tried to guide towards the next few quarters. One question that obviously came up is about their acquisition pace. Something we have been talking since the end of last year, beginning of this year, is Openly has massively reduced the number of homes they're purchasing. We are down to like a few hundred homes a week. I think they're listing about 200 homes consistently over the last few.
100 homes a week in acquisition volume right now.
They mentioned that we should expect a pickup in volume as we move through the second quarter. So I guess we won't see much anymore in the Q1 data. For context, our purchase data is basically 4 weeks delayed. It takes 4 to 6 weeks to completely report data to county assessors. There's no forward-looking data we can look at like with pendings. So we just have to wait it out. That means we probably won't see any increase until the end of April, right? That's what they're kind of hinting towards.
Mhm.
They also talked a little bit about them increasing or decreasing spreads a little bit. I guess they saw some of that home sales activity going a lot better than they seasonally expected in January and cut down on spreads. But they also said, hey, as soon as we're seeing that data turn around, we're gonna put spreads back up there. So there's not a lot of hope for going back into growth mode anytime soon. That's kind of gets us to the next topic, which is they talked about what the path to positive adjusted net income is and when that might happen. So what they carefully talked about is becoming adjusted net income positive by mid 2024 with a revenue run rate of $10 billion, which is again a head scratcher because we are right now on a higher revenue run rate than $10 billion and nowhere close there. That probably indicates that the next quarters after Q1 will be not even close to the same revenue. That aligns with the purchase data that we are seeing. There just won't be enough homes to sell. And probably they're going to increase towards where they were at scale again of $10 billion run rate,
Right.
which they say is basically the scale they were in 2019 by mid 2024.
Yeah. And I think the important point here is that revenue doesn't matter, right? Like for Opendoor, revenue never mattered. It never contributed to stock price, right? Like when Opendoor had, 5 billion revenue per quarter, the stock price was just falling, right? It was in free fall. No one cares about revenue for Opendoor because it's considered low quality revenue. And so I, as a shareholder, am not so much worried with Opendoor guiding for lower revenue. What I'm most interested in is them finding a profitable business. And so I don't care if it's 2 billion in revenue because there's no multiples that Opendoor is being valued on that are based on revenue, right? It's all about profitability, especially in this down market. And so if Opendoor can find a profitable business somewhere in that space, then I'm all for it. Even if it's, at the lower, I mean, I remember we were talking about this last year and the year before when it seemed like this housing market would go forever, that, 40 billion revenue a year didn't seem unreasonable, right? I mean, they're barely scratching the surface of penetration in the United States. If iBuyers got to 10%, for example, that's a $600 billion business in a year like 2024.
Yeah, but basically what they're telling us with that is that they expect to drastically change their cost structure
Right.
because adjusted net income positive is something we've only seen at $20+ billion in revenue, which would be double what they are saying expecting for next year. And the explanation here was that they are working on removing 100 basis points of margin of share costs from the system. There wasn't much more explanation to that. There could be things that they were pushing out for a long time because they thought they can scale things with people instead of like automation that they're now identifying and it's the right time to solve them. It could be meaning because they're reducing acquisitions and sales, they're gonna need a lot less staff. There's a lot of staff that is variable versus people that they actually hire, right? That could be part of that. Um, but still in head scratcher, even with 100 basis points cuts, it's kind of we're not getting to adjusted income with 10 billion in revenue. So there's a little bit of a question mark, especially since Carrie said there's not a lot of assumptions with asset light, um, capital light parts of the business contributing to that. So it's not going to be the third party marketplace. It's not going to be buy with Opendoor or list with Opendoor that makes up a big uh, amount to get there.
Yeah. Yeah. That's true. And as you said, she didn't really outline much in the way of um, specific, policies or measures that were going to lower costs so substantially. But I think to you and me, it makes sense, right? Like Opendoor was positioned for hyper growth mode basically since they went public. They were scaling as rapidly as possible. They were buying as many homes as possible. They were able to push Zillow off a ledge because of that tactic. And so the idea that a company that's hiring and growing and focused on so many different bets and moonshots can suddenly pull all of that back and, uh, you know, save at least 100 basis points of cost structure seems pretty likely. And I know that she said that third party and lists with Opendoor weren't going to be material parts of this estimation, but they will be, right? Like they have to be for this company. And so I think those are probably two topics worth discussing, right? Like the change in the goals for third party, but then also the real nugget, I thought, like the best part of the whole earnings call was her commentary around the product market fit that they found with lists with Opendoor or lists with certainty.
Yeah, talking about third party, um, I guess the big shocker, or for us, it's not a shocker because we were quite critical of the goal in the first place,
Mhm.
is last year they were talking about getting to 30% of their sales going through their marketplace. That goal seemingly got revised or clarified that it's going to be 30% of sales in the markets where they roll, which currently is Houston, Dallas, and Austin. And so a very different goal than what we heard last year.
Yeah, yeah. I think Eric Wu talked to Ben Thompson about this on Stratechery in November, December, whatever it was. And that's the project that he's currently leading is getting exclusives to be this material proportion of Open Door's overall transaction volume. And I think we've been sort of critical of this plan from the start, right? Because like I said, at Datador, we monitor exclusives volume, both first party and third party. But it's hard to imagine for a company selling 40,000, 30,000 homes a year that Opendoor can suddenly get to 10,000 homes sold through this third party marketplace, um, within a year. It just seems like an impossible amount of scale. And a few months later, on the earnings call this past Thursday, Carrie confirmed our skepticism and said that only in the markets that Opendoor is currently activated, they're going to be 30%. I think what was exciting to hear her say, with that significant caveat, is that they're really working on the product, number one, to make sure that when they do scale it, it's right. But number two, that they were going to be adding more markets this year. And I think that that's really important. Although when I do the math in my head right now, it's Austin, DFW, and Houston, right? Yeah. So that's like 80+% of Open Doors Texas market, which is historically like 1/5 to 1/4 of Open Doors overall book of business. So it's a significant percentage of homes, right? I haven't done the math on it just yet, but if Open Door actually did get to 30% in 20%, that's 6% of their overall business. I'd still be pretty happy with that. And it would definitely contribute to the bottom line, at least this is back of the napkin math, but probably 50 basis points in gross margin, maybe a little bit less. Which I mean, it all helps, right? 100%, 100 basis points of cost saving plus 50 basis point improvement in gross margins. That's a, I mean, that's a big swing in the viability of this business, and certainly cash burn.
And we've seen a lot of movement on the or only on Opendoor exclusives in the last few weeks. Obviously, we saw third party number of third party listings increase. I think for the first time there were more third party exclusives listed than actually third party exclusives, which is the right direction. Um, the other thing we saw is a lot of experimenting in in filling up in filling up the content of the page, right? Especially in Austin, we're at the point where they only had like 8 listings on the page. Something they're experimenting with right now, which we discovered last week, is that they're actually listing their own first party homes listed on the MLS, also on exclusives, so that a buyer can buy the same homes that Opendoor lists on the MLS directly from Opendoor for a cheaper price, basically without the buyer agent commission and with the same benefits of any other exclusive home. So 50K appraisal, price match, and everything else that comes with it is another interesting development. It's probably what we would like to see nationwide. An ability for buyers to directly buy homes from Opendoor would be a massive cost improvement to the whole business. We'll need to see how that develops in the next few months. And what the product that they're trying to fill the void of not having the exclusive available nationwide is a list with certainty. It's a semi-new product from Opendoor. They offered list with Opendoor for some time in the last few years, where basically they connected you with an agent if you really wanted to list your home on MLS instead of taking a cash offer. And it was kind of one of the options that were buried somewhere. What they did experiment with in the last few months, which they mentioned on their earnings calls, like they explicitly promote list with certainty as an additional product to getting your cash offer to sellers where spreads in markets where spreads are really high. So if you're coming to Opendoor to get an offer, they're using for the first time, they're aggressively using this funnel of seller leads to actually get them to agents, which is something that would have been obvious for a long time. It's something they could have tapped into for a long time, but they only decided now to. Um, what do you think about that, Tyler?
I So, like I said, I thought this was the best part of the earnings call. And granted, I think a lot of the earnings call left me scratching my head and a little bit frustrated. But this, I thought, was sort of the exciting point of the earnings call. Basically, what Opendoor is saying is that when it provides an offer for a homeowner, it doesn't always convert those homeowners. And in fact, it's only converting about 10% right now, given that it's offering such low values for homes that it can be safe, right? And maintain positive unit economics for all the homes that it purchases. Um, and so I think what they've realized is there's still a large percentage of people that were high intent home sellers that Opendoor wants to monetize. These are leads, right? And so as opposed to selling to the Zillows and the Redfins of the world, right? What Opendoor is doing is they're saying, okay, we understand that this price isn't right for you. But I think it's valuable to have this offer in your back pocket. And so what if you list with us, right? What if we connect you with other potential home buyers and other offers? And we'll take a small cut of the eventual sale. And at the end of the day, if you don't find anything that you like, you can always sell to us and you have a guaranteed cash offer. And what they found is that 20 to 25%, this number is enormous, right? Like 10% right now are converting to traditional Opendoor offer. 20 to 25% are converting to this list with Opendoor, list with certainty. And what that means is that Opendoor is taking a completely profit, like 100% profit cut from these home transactions. What is it, Sebastian? 1.5%, 1%. How much is it?
Yeah. So we don't know the fee structure of the new list with certainty product, but based on the old list with Opendoor product, basically they're charging a 5% commission fee to the seller, which is equal to the 5% they would pay Opendoor to get the cash offer. 1% of that goes to Opendoor. 1.5% goes to the partner agent that works with to list the home, and 2.5% go to the buyer agent.
Yeah.
Which is depending on the market, but that's like the default buyer agent
So,
commission.
so at least 1% of that home sale is going to Opendoor, right? And in that situation, Opendoor didn't have to use any of its balance sheet, didn't have to use any leveraging, didn't have to pay HOA, didn't have to pay repairs, didn't have to pay property taxes, right? And Opendoor is still getting 1% of that home. And that's really important that Opendoor has found that space. And while it's not exactly third party, right? That was at least a 3% profit on those homes. 20 to 25% of Opendoor's not insignificant funnel converting to this um, list with Opendoor to get 1%, I think is going to be a meaningful component of Opendoor's business. Now, the question is, how did they suddenly find this product and why did they revive it? Here's my theory for why. In 2021, growth companies, private companies reached astronomical valuations, right? Investing was fun. And that has changed, right? In 2022, investing became not fun, particularly if you like technology companies. If you like boring companies, it was probably just fine for you. But companies like Opendoor, and particularly real estate technology companies, suffered. And the reason I bring that up is because you can't really raise at this point in prop tech. Like if you didn't have the cash to survive this downturn, you're really struggling. Take a look at Ribbon. They recently laid off nearly 90% of their staff because it's so hard right now, right? Like home transactions are down 50% year over year, at least early on. And home values are down as well. And so what I'm getting at is that the power buyers, right? The companies like Orchard, Ribbon, Knock, they're really struggling. And so I think in 2021, when they were all very well monetized, well funded, aggressively aiming at growth, they could compete against the open doors in this power buyer space, which is what List with Open Door is. In 2023, these companies are weak, right? They are devitalized and anemic. And I think Opendoor is recognizing that opportunity as a better funded public entity with a bigger balance sheet, more opportunistic, I guess, to take advantage of this space and fill this need because other companies have gone before them and kind of created this product market fit. Opendoor is kind of capitalizing on that in this down market.
Yeah, it's a fascinating. I wouldn't call it. It's a very creative way of using their seller funnel to still be able to capture part of the transaction that might happen anyway of serious sellers. What's interesting is the certainty part. So the product we had before is just list with Opendoor. So we connect you to a seller agent, then you're gonna do the regular MLS listing, and you obviously can get an Opendoor offer, but that will expire in 14 days. What the certainty piece means here is that while you're listing on MLS, you can fall back to the Opendoor offer at any time. I wonder what the conditions here are. Is it for 60 days? Is it for 90 days? Is it really forever? That would be kind of weird. But basically, if you see wants to buy my home, you can put it off market. You don't pay anything, and you take the offer from Opendoor. And at that point, it's a regular seller conversion with likely very high spreads, right?
It's basically like the third party marketplace.
Yes, it's very similar to the third party marketplace, where the marketplace is just a regular MLS.
Right.
But it's using the same. It's solving the same problem for the seller. So they know the exclusive marketplace is not ready yet to be rolled up nationwide. it probably would do a disservice to them iterating on the product if they decide to go outside of Texas and now they have to deal with the different ways home transactions work in each market while iterating on the product, messing things up, keep- keeping it small, iterating on that. When they're ready, they're going to roll out more, expect by the end of 2023. Um, but in the meantime, they figured out this twist on the product they had before to still convert sellers, which I have to give them a lot of credit to. It's an interesting approach, and obviously it's hard to see other than what the Opendoor is going to report on that. It's going to be hard to capture data on this on how successful it is, but it's quite promising. Um,
Yeah, I mean, I would go so far as to say this is the economics of the listing with Opendoor model is maybe 1.5% to Opendoor, right? In terms of profit. For exclusives currently, third party, it's 3% of the home sale price. I would go so far as to say that if there's significant regulatory issues or difficulty scaling the third party marketplace, list with Opendoor is a product that no one else can build, similar to the exclusives marketplace outside of OfferPad, but they just don't have the scale for it, I think, currently. Um, and it seemed like they've already found product market fit if they're converting 20 to 25% of sellers, right? Like basically, basically what they're saying is it costs you an extra 1.5% to, um, even that. I mean, we don't know the economics of the transaction just yet, but basically what it's saying is you have a guaranteed offer in your back pocket. But we will help facilitate your home sale. We'll take some of the burden off you. And actually with all of the other like appraisal, match guarantee, and all the other benefits that you get in the third party marketplace, I mean, I wouldn't be surprised if the the margin, like the actual gross margin of the third party, or sorry, the list with Opendoor sales are similar to the third party marketplace.
and theoretically, it can be available nationwide today. I
Right.
we don't know
Wherever
in what
Opendoor
market
buys
it's
home.
currently rolled out.
Yeah.
Yes, just what's interesting here, and maybe we can dive into this a little bit deeper next time. But it obviously for Opendoor, it also has an impact on their potential sales price of the home if the home was listed once and taken off the market. If the seller decides to list with Opendoor and then after what, okay, I don't get any offers, I'm just going to take the cash offer. That home has an MLS entry saying it was taking off the market, which usually indicates that it's not a great home. Like it has an impact on valuation. I guess that is also covered by the increased spreads at that point. Um, it's a really fascinating
Yeah,
topic to dive deeper into that.
you'd have to model it in because the homes that do convert to an open door sale, you need a bigger spread. And the homes that don't, you probably wouldn't. Right. So
Yeah.
it's it's an interesting data problem for smarter people than me.
I guess we need to do another episode. We talked about this last time on all of Opendoor's power buying capabilities,
Yeah.
both on the buy with Opendoor side and list with certainty now. It's pretty fascinating. Um, all right. We are already 40 minutes in. So let's cover one last topic. And I feel like we're going to have to do another episode on all the things that came up in those earnings because it has been a lot. But there was a lot of shocking news. It was not mentioned on the earnings call, but there was an SEC filing that Daniel Morillo, chief investment officer, left the company, resigned. I think it was a resignation. Yeah.
Yeah. Yeah. I was a little shocked about this. I've, I've read the interviews, and spoken briefly with the guy who was Daniel Morillo before Daniel Morillo, and a lot of ex Open Door employees who all really respect him and sort of his contribution to the company. I've also met Daniel Morillo one time, and we chatted briefly about Zillow's demise and how Open Door responded in Q3 of 2021. I think it's a shock. He's obviously been an integral part of Opendoor's performance as a public company, and he's run the entire pricing team since they went public. And so seeing him leave, uh, plus the reshuffling lately, Andrew Low-Key, Carrie moving to CEO, Eric moving to president of marketplace. There's been a lot of changes from the company, C-suite that went public uh, a few years ago.
Yeah, I guess we will need to monitor Daniel's LinkedIn profile if like he had plans for something else that where he thought his time might be more well spent at an open door, if there was a more of a disagreement at the top and he left and just gonna go on vacation for a year. That will be interesting to look at.
And
We will
we,
never hear the full story here, probably.
well, unless Daniel comes on the show and tells us, I can tell you this: he can make a lot more money working pretty much anywhere that he's qualified for outside of Opendoor, right? Like, uh, definitely took a pay cut coming from Citadel to Opendoor.
Yeah. All right. I think that was a good summary of the most surprising things we heard last week. We are we're still planning to do a Twitter Spaces. I guess we have to explain. We had a Twitter Spaces uh,
Scheduled for
booked
Thursday.
or arranged for first day, the day of earnings. But before earnings, this is important. We canceled before earnings. A lot of people speculated that after we saw earnings, we just cancel it. That is not the case. We're not that shocked. Yeah, Tiny Egg shared like an emergency situation at work, right? I'm not
Yeah,
sure if you want to go into
we can
the
we can
bloody
share
details here, but
yeah, we can share the texts to confirm the timing of this event. It definitely wasn't because Open Doors results were very different than what we expected. I have a different day job and it's not very flexible, and something came up and I couldn't make the spaces.
yeah. So we probably schedule this maybe for next week or
Let's do it this week.
yeah, definitely or this week. Uh, we will take any of your questions and we're looking forward to talk to you. So make sure to follow us on Twitter and obviously get a Datador subscription to um, read all of our follow up that will come in the next few weeks and months about how we think Q1 will look like and beyond. And it's going to be an eventful next few months. Um, and we will be here to talk about it on the way down and hopefully on the way up.
Yeah, hopefully eventually there's a way up. That I'd like to see that myself.
What a somber episode. But there are some of these. Yeah.
Yeah. I mean, I laughed a few times. I think it's a tough time to be a growth stock investor, and particularly hard to be a prop tech investor, right? But Opendoor has a plan. They're a smart company, and they have a lot of opportunity ahead. And I think for the most part, they have a monopoly on the space. Or they're certainly not competing for price with a competitor, right? Um, and so I think that's important, right? When Zillow was around, it was a trickier time. OfferPad's around, and certainly they're doing fine as well. It's just they're competing at a different volume than Opendoor right now, and they too are trying to just survive this current dislocation. And so if either of these companies can make it through, there's a huge opportunity to be a middleman in residential real estate. But in the meantime, there's a lot of there's a lot of speculation and a lot to sort of follow in trend to figure out if it's going to happen. And I hope it does, because I really do think that we need innovation in the residential real estate transaction. There never has really been innovation in this space, and that's why I think both of us get so passionate about this issue and why we've defended companies that are attempting it. But it's a tough time. It's a tough time to be attempting it, and so we're gonna keep following it.
And Opendoor still seems to be in this seemingly best position to make a change, right? There's nobody else left, like you mentioned. So, uh, yeah. All right. Talk to you next time, Tyler.
Yeah, sounds good. Bye, Sebastian.